Good morning, everyone. So time now is 9 o'clock. So we're going to kick off this webinar. So good morning, everyone. And my name is Hal Freeman, and I head up RSM's real estate construction team. And I'm delighted to be able to welcome you here this morning. It's the first time we've run this event on this platform. Normally, this will be a physical event based in our London office in Farringdon Street. So I'm actually delighted that 400 people have registered to attend this event. So I hope you enjoy the session this morning. In terms of what this morning is going to look like, we'll give a 10-minute run through our Real Estate 360 annual market survey and run through our findings. I'm then going to hand over to Matt Oakley and Lawrence Bowles from Savills, who I'm delighted who joined us again. I think this is their fourth year in partnering up with us on this particular event. Matt is head of European research at Savills, and Lawrence is a director in Savills' research team on the specialism in residential property markets. Their joint session will run for around about half an hour. And we'll then do a Q&A session with a hard close at 10 o'clock. In terms of the Q&A, just some guidance. If you look on the right-hand side, bottom right-hand side of the screen, you should see a Q&A function. If you could submit questions as the presentation runs, we'll pick those up at the end of the session. We'll try and respond to those. Or to as many of those as we can. So then moving on to our Real Estate 360 survey, results of which we have just published. So a little bit of background behind this. This is the fifth year in which we have run the survey. We actually surveyed people in November last year, and it's very much a national survey, so we've got a national picture around the UK. And I'm delighted that we had over 300 responses to what was a pretty full and lengthy survey. So we were absolutely delighted about that. Just by way of introducing our findings, I'm going to run a short animation which runs for about a couple of minutes, which highlights some of the key findings. And then I'll go into a little bit more detail on the actual findings themselves. 5 key findings that we wanted to highlight. First was clearly and unsurprisingly the impact of the global pandemic. Secondly, was in relation to the regions, which continue to look stronger and stronger as the years go by, and perhaps a move away from London. Thirdly is just looking where investment's coming from, both geographically and from who and where. And ultimately, we looked at whether perhaps we are now in an industrial revolution, which has really been accelerated by the impact of the global pandemic. And then perhaps looking at some of the defining trends, some of which are significantly down to political influence. So moving on then, looking at the pandemic and the impact of the future of work. And here we looked at the future of office. And again, perhaps unsurprisingly, 60% respondents expected commercial office demand to decrease over the next 2 years. But interestingly and conversely, 81% thought that demand for flexible office solutions will increase, and perhaps people are looking for a more flexible solution to their space needs, and not necessarily looking to reduce their space needs significantly. Clearly, people did think there will be a surplus of city centre space, which was interesting, and perhaps that's the move to what people call the hub and spoke model, moving out of the centre into the suburbs in the key cities which we work in. And finally, some of the comments we've had is that people believe, and I agree with this, there's going to have to be an evolving relationship between landlord and tenant, and perhaps more like the tenant's going to have to be treated more like a customer than historically as a tenant. And then moving on to the strength of the regions, interestingly for me, London was still seen to be strong as a commercial market, notwithstanding the impact of the pandemic. But the West Midlands and North West also look to be pretty strong. The residential markets, South West, South East and Yorkshire, were seen to be the strongest. So where's the money going to be coming from? So you will have noticed that the percentages close to are certainly more than 100, and that's because, just to remind you, people had more than one option to choose. I think we allowed to pick 3 options on this in this particular question, where we asked people where they thought the money was coming from. So I suppose unsurprisingly, Asia and the Middle East were thought to be the strongest. What was a surprise to me is that Europe came out pretty strong as well. So that was pleasing to see. And I think certainly from recent experience I have seen in terms of transactions we are seeing in RSN, we have seen some interest, increasing interest from Europe. And certainly who will be investing? So real estate funds came out on top, and we know certainly that real estate funds, there are a lot of cash to deploy. I think they've been sitting on cash as really waiting to see what happens following the pandemic as things settle down. And certainly since the survey was concluded, we've seen more activity by the funds in the marketplaces. This was followed by UK private companies, REITs and publicly listed funds, institutional investors, and then high net worth individuals. So then moving on to the Industrial Revolution, and what did people think? Well, this was clearly a revolution in terms of where people's priorities were in terms of asset class and where they were going to invest. Clearly, we all know that certainly for the big funds and institutions, they wanted large amounts of capital. It would have historically gone into office and retail. Well, clearly, they have been severely impacted by the global pandemic, and now people are looking to the future on what's going to happen. Industrial came out on top, and that's really down to distribution centres and sheds, closely followed by data centres, again in support of on online transactions, and people need to store people's data and process people's data. So moving on then, so where is the industry heading? So this was quite interesting. Certainly about what people's thinking are in terms of what people's priorities are. ESG and sustainability comes out on top, with developers increasingly recognising the need to build sustainable assets, particularly as funds in particular are benchmarking the assets that they're investing in and are having to be seen to invest in sustainable assets. And this was closely supported by green energy options and infrastructure, and the need to prioritise in green options for the UK economy, and a particular focus on the real estate sector. And finally, government policy will be critical, particularly looking at business rates reform, which has again been unfortunately put on hold. Planning regime changes as well will seem to be particularly important. I think the real estate sector has been very critical of the delays in the proposed changes in the planning regime. So that's a quick run through of the results of the survey. I'm now going to hand over to Matt Oakley to talk through his view on the UK commercial property outlook. So Matt, over to you.
Thanks very much, Howard, and it's a great pleasure to be back, unfortunately, from my spare room rather than enjoying the usually excellent RSM breakfast. But I'm just going to give you a quick run through how I see the commercial markets panning out over the next couple of years. Some things I agree with the results of RSM survey, some things I don't, but that might make for a lively debate later, and then hand over to Lawrence, who will do much the same thing for the residential markets. But just starting with a few macro points, I guess rather than reading every single word on this, I would say that everything depends on how quickly we emerge from social distancing. And I put these slides together last week, pre the government's roadmap, and broadly the roadmap fits into what we were expecting. Q1 this year in the property markets remaining fairly recessionary. I don't actually see a sort of strong bounce back in Q2 in commercial property markets. However, the economic growth story obviously will be significantly stronger in the second quarter. When you're digging down into sort of elements of the commercial property sector, office markets, CBD retail, their recovery depending very, very significantly on sort of when people come back into city centres as tourists, as business people, to work in their offices. The feedback we're getting from our clients on the sort of corporate clients on the occupational side is that a significant proportion of companies don't expect to have their staff back in their offices until September this year. So again, I think that recovery going to happen rather more slowly in some parts of the commercial property market than the economy as a whole. And actually, while I'm not a massive believer in the things will be different this time and the new normal, I think definitely something has changed in how we work and where we work. I think those of us who sort of started our careers expecting to trudge 5 days a week into a city centre probably won't be. But every survey I've seen suggests that we will be spending the majority of our time in CBD office. So actually, probably not that much will change. And in terms of property as an asset class, started the year pretty strongly, actually. Investment activity looking quite good for January and early February. And I think this is just a function of, once again, property seen as slightly the least worst asset in a world of comparatively low returns. Brexit is obviously a big question in many people's minds. I was rather hoping that it would have gone away by now. Again, I think it's going to drag on the economy in the first quarter of this year, particularly in the sort of manufacturing, logistics and retail sectors as people struggle with the new computer systems, border delays, etc., etc. Our clients in the distribution sector are expecting that to sort of that impact to soften through Q2 and by Q3 to be back to relative normality. Still significant questions in place about the prospects for sort of Brexit around services and most notably financial services. I think, this will be this memorandum that we're expecting between the EU and the UK on financial services equivalency is deliverable by the end of March. And I think that will remove a lot of the uncertainty, or some of the uncertainty around office markets in London, and will leave us then just to worry perhaps about the question of how and where we work. But generally, if you look at the trajectory of what happened in the commercial property investment markets last year, it's a pretty optimistic story. You can see here the comparison of the monthly totals of investment in all commercial property assets compared to the 5-year average. And by September, we were just edging back to normal levels. September, October, November, all pretty normal months. December actually slightly stronger than normal. I think the latest lockdown is going to drag on January and February numbers. January is never that active a month anyway. But I think by Q2, the removal of sort of Brexit uncertainty or reduction of Brexit uncertainty, a little bit more clarity around the sort of roadmap out of COVID and when sectors coming out, we should see the investment markets broadly returning to normal, at least in sort of macro volume terms. In terms of where the money is going, I don't see a dramatic change ahead. And I think a lot of people have been talking about the sort of new normal post-COVID, retail being more and more online, that therefore hits sort of retail property. Talking about this as a new thing, this trend has been going on for a decade. As you can see here, this is looking at where investment activity took place across the commercial property market, and I think this trend is going to continue. While Howard sort of highlighted the industrial sector, actually a lot of people sort of think that all the money that came out of retail went into logistics. A bit of it did, but actually most of it went into that sort of that other box at the top of my chart, much of which is beds-based type asset classes, multifamily in particular. And again, it's not a new trend, it's not connected to COVID. I think it's going to continue to be a trend in the market going forward. So generally, I think, if we're just a quick word about what's happening in each of the key three main sectors in the office markets, a very, very normal recessionary story, actually. Subleasing rising, take-up falling last year, development starts being delayed. And what we will see going forward is further rises in vacancy rates, downward pressure on secondary rents, but not necessarily prime. I think the big difference between now and the last crisis is limited landlord stress compared to the global financial crisis. But subletting, the chart on the right shows the amount of sublet office space on the market in central London. It has risen dramatically, and I think this echoes some of the findings of RSM's survey. And it is going to be a challenge for certain types of landlords who hold perhaps comparatively small space, secondary space. But if you look at central London office vacancy rates, they did come up last year. The city still remains below its long-term average, the West End a little bit above. So if any of you are sort of heading out into the market this year to acquire office space in London, I think it will be a slightly easier negotiation. Landlords slightly keener to do deals. You might get a little bit more rent free, but actually the trend in terms of sort of prime office rents last year was either flat or indeed slightly up. Again, a slightly surprising story, but this reflects the fact that we came into the crisis with low levels of grade A space. Another surprise of last year is actually non-domestic investment. Around half of all the investment in UK commercial property came from abroad last year. Some markets, Edinburgh, for example, I think it was more than 90% of the purchases were by non-domestic investors. Central London, the biggest destination for non-domestic investors. You can see maintaining its level at sort of, around 75%. So despite the fact that, it was virtually impossible for international investors to travel for much of last year, there clearly still is an enthusiasm for London and the UK as a destination. And I think that's going to carry us through this year as travel corridors open up. And again, a very strong recovery in investment activity in the final quarter of last year. We saw around 5 billion turned over just in the London office market in the final quarter, which was higher than the preceding 3 quarters added together. So again, all feeling like it's, well on trend to get back to normality. On the occupational side, I think what we're seeing is tenants going into wait and see mode. This is looking at the volume of requirements, so companies looking for space in the London office market. And you can see that it actually went up over the course of last year. That's not really because new companies are entering the market looking for space. It's just, the companies delaying decisions, and that, at some point those decisions are going to be actioned. And what we're seeing on the ground is not actually a lot of negotiation around rent or lease of sort of rent-free periods. Companies just wanting more flexibility, again echoing the RSM survey. So it's very common where we're acting for tenants for them to say, look, we have no idea how much space we're going to need in 18 months or 2 years time, but we know we're going to need some, and we want to build into the deal a degree of flex where we might take 75,000 square feet or 100 or 125, but we're not going to be penalized for taking the lower end or the higher end. So I think, a real trend of companies not knowing where they are and where they're going. And I don't think many office-based businesses are going to have a lot of clarity around this until the autumn or possibly next spring. They really need to see how many of their staff return to work, how often. Again, echoing the themes of RSM survey, a much stronger or less bad year last year in the regional office markets than in London. This is looking at the year-on-year change in office leasing activity. So while London was 60 to 70% down, the big regional cities were only around 25% down year-on-year. Edinburgh standing out actually is one of the few markets that saw an increase in leasing activity. And I also agree, I think I'm probably more of a fan of the regional office markets because they're undersupplied with grade A space. They actually, demand seems to be holding up better. There's less subleasing activity. And as you can see here, 44% of the development pipeline in the regional cities is already pre-let against a background of, very low levels of availability. So in most of the big regional cities, there is yet less than a year's supply of grade A space. And with developers going comparatively risk averse post-recession, that's not going to be added to. So I think there's going to be some sort of real pressure on rents in the big regional cities, and actually we saw it last year while London office rents were broadly flat or slightly down in the case of the West End. As you can see here, Birmingham prime rents went up by 7%, Leeds up by nearly 7%, and this is just a reflection, I think, of the story we're going to be living with for the next few years. Tenants becoming increasingly focused on the best of the best. We need to deliver an amazing space and an amazing place to seduce our staff back into the office, and that remaining at relatively short supply going forward. So I think, quite a good positive story ahead for regional offices, less so for retail. Retail is arguably, the sector that everyone has loved to hate for quite a long time, but one or two areas of opportunity emerging. If you look at the footfall chart on the right, the top line of this shows footfall on retail parks. Retail, back last autumn, and when we could all go shopping, retail parks, footfall got almost back to normal levels. A reflection, I think, of the type of goods that retail parks sell. The fact that they're big open spaces, so they're quite easy to social distance in. And interestingly enough, retail parks was one of only 2 areas of the commercial property market where investment volume or investment activity was up year on year last year. The rest of retail, I think, is going to be a real question of, what do you do with stuff that needs repurposing? Some will go to other uses, some will stay vacant. And I think, all eyes forward to Easter for retail, because parts of retail, that's a very important period. A lot of chat last year about turnover rents. We really haven't seen much evidence of turnover rents being negotiated. It was the topic of many conferences, but actually similar to coming out of every other crisis, we haven't seen a lot of action, just a lot of chat around turnover rents. The one exception to the very normal recessionary trends that I've outlined in the commercial property markets is logistics, again echoing RSM's survey. This is looking at leasing activity, take up in the big sheds market. So this is units of 100,000 square foot or above, and it was an astonishingly strong year last year, record on every possible measure. Leasing activity was up 50% year on year. Investment activity was up 25% year on year. It was the best year ever, and this was driven by that continued swing, or to online retail, accelerating because of COVID. There's definitely an element of Brexit there, and as we entered this year, this strength has really continued. We're seeing record levels of requirements out in the market, much of which actually is probably more driven by Brexit stock building, dealing with delays in just-in-time manufacturing processes. So relatively short leases, but again, very, very hot on the occupational side and very, very hot on the investment side. And I think expect that to continue going forward. For the first time ever in the UK, logistics yields are the same as London office yields. Perhaps we can discuss whether that is rational pricing. It is just simply a function of the fact that almost every private and institutional investor out there wants to buy logistics, and there is a comparatively short supply of them. So I think this is about investor demand and supply rather than about forward rental growth prospects. But I don't think it's going to change, potentially even further downward pressure on logistics pricing. So just to sum up my bit, I think a very typical post-recessionary pattern, actually. No real signs of a new normal emerging, limited amount of debt out there, limited development activity. Retail, there's always a hangover in the retail sector, and a lot of that retail space is going to have to be repurposed or densified. But actually, I think we're going to see the opportunistic money continuing to come into this market this year, looking for good retail that we want, that is starting to look very cheap indeed. Offices, I think, as long as it's good, prime, green, it will be incredibly popular with tenants, and there is going to be a shortage of that amount of space. We're just seeing a slight hesitation in the investment market, questions about whether offices are as core as they used to be. Normally, coming out of a recession, offices will be the hottest segment of the market because they're seen as very low risk. I think just investors all over the world just waiting to see how we return to work, what days, how often. But again, I think offices are going to remain the largest asset class for quite the foreseeable future. Logistics continuing to be hot, and alternatives, I think, becoming increasingly core. While 2 years ago it was sort of beds and sheds, beds, sheds and meds now seems to be the buzzword. So I think anything with a research or science tag attached to it is going to be increasingly popular, and I think we're going to see a lot of repurposing of space for those kind of sciencey uses. But actually, most of that money continuing to be targeted at residential type assets. So that leaves a perfect handover to Lawrence. Thank you.
It's almost like you've done this before, Matt. This is doing very well indeed. Good morning, everybody. Thank you very much for joining us here. As Matt said, we are now going to take a look at what's been going on in the residential markets, and of course, the strapline there hinting at one of the defining features of the residential market over the last few months. And by the look of things, over the next 3 months, we've seen those headlines this morning suggesting that Rishi Sunak will be extending the stamp duty holiday until June. I'll be discussing that and various other things in this presentation. I'm going to start by looking at the residential sales market and how things have been performing there, what we expect to happen to pricing over the next 5 years or so. I'm then going to turn to the rental market and present some of our latest findings there, and then finally take a bit more of a detailed view on the prospects for new housing delivery, which I think, as Howard pointed out, was one of the key opportunities for growth for activity over the next few years, according to that survey. So taking a look at just over the last 12 months or so, 2020 is very much an unusual year for a variety of reasons, but particularly looking at the housing market. It is the first time ever that we've seen residential pricing, residential values diverging from the wider economy. We saw, of course, GDP falling by of an order of around 10% year on year. Meanwhile, house prices rose by about 7.3%, according to the Nationwide. There's a few reasons for that. Partly it's these circumstances in which we found ourselves moving into that falling GDP. We had a period of very low house price growth leading up to that point, which meant affordability was less stretched than it has been in the lead up to previous downturns. We also had a very low interest rate environment, and of course the Bank of England acted very quickly to slash rates further and to inject more money into the economy through QE, which has helped to avoid some of those forced sales that we've seen in previous downturns. Add to that the government's intervention on jobs through the furlough scheme, and of course that stamp duty holiday, and we've seen a much more robust recovery in the housing market than in previous downturns. Now that's left us in a situation where those people who can afford to move, those people who've got a bit of equity behind them, have been trading ever more aggressively in making purchases driven as much by behavioural change and sentiment as by the economic situation, and a real shift in preference towards homes that have got a bit more space, that have got a bit more flexibility to act as schools and workplaces, as well as just places to sleep in between shifts. Meanwhile, for those people who do not have the equity to move home or buy their home, there we have seen a much weaker performance in terms of the rental markets, particularly in urban areas, particularly in those areas where the rental market is dominated by people working in the service industries that have been so hard hit by this pandemic. So we're in a situation where transaction activity is running significantly above the same time last year and the 5-year average. December we had transactions completions running at 34% above the same month in 2019. Mortgage approvals over 60% higher than in December 2019. And so we're expecting to see that activity continue to be very strong through the first quarter of this year, and given the extension to the stamp duty holiday, potentially some spreading out of that impact over the next few months, the following few months as well. This chart shows a bit of a sort of overall summary of what's been going on in the housing market. Those yellow bars reflecting that annual level of house price growth as recorded by the Nationwide. And you can see there, we did indeed see house price falls in the first lockdown. Prices fell by about 0.1% in June 2020 before rapidly rising out, fueled by the stamp duty holiday and people desperate to move following that first lockdown. Peaking at 7.3% in December. We've seen the price growth come off a little bit in January, with falls month on month of about 0.3%. We are still awaiting eagerly the next month data from Nationwide there to confirm whether that is just a short-term blip in the data, or if indeed there is some heat coming out of the market as we approach what was going to be the end of that stamp duty holiday. But you can see there in those lines, these lines represent sentiment. Have surveyors seen an increase or a decrease each month in the number of new buyers coming in through their doors, or indeed going on their websites given we're locked down? Have they seen an increase or a decrease in the number of new sales instructions? You can see there we saw the most widespread fall in sentiment, the most widespread fall in activity reported in April, and then the most widespread recovery in that activity as we move through to June and July. So the market very much keen to get back up and running again. And that's reflected, as well as in the sentiment figures and in these price growth figures, that's also reflected in these transaction figures. These we've taken from Analyst 20CI. They show the number of sales agreed subject to contract in those sort of teal bars and lines there, and the number of new instructions, the number of new properties being brought to the market in the yellow. And you can see there through the course of last year, for the majority of that time last year, we saw both of those figures running higher than the same point in 2019. And in particular, through the first part of January, on the right-hand side of that chart, you can see the number of sales agreed running significantly above the same time in early 2020, with sales agreed running at around 40% above the same time in the previous year. That's been driven to some extent by that sentiment, but it is being driven particularly by those people with more equity, as I said earlier. And that's because for those people who have equity, mortgage lending remains extremely cheap. This chart on the left shows the average quoted rate for a 2-year fixed mortgage. In the yellow line and the orange line there, you can see the rates being quoted if you have a deposit of 40% or 25%, if you've got a loan to value of 60% or 75% respectively. The rates there remaining at historical lows, and particularly if you've got 40% behind you, mortgage rates are about the cheapest they have ever been, despite all of the uncertainty we face. By contrast, if you're trying to buy with a 10% deposit, you're looking at the red line there, you're borrowing 90% of your property's value. There, the interest rate you could expect to pay on your mortgage has risen from around just shy of 2% at the beginning of 2020 to just shy of 3.5% or just over 3.5% as we moved into the second half of 2020. That's had a really dramatic impact on the ability of first-time buyers in particular to access home ownership through the latter half of last year. The situation's starting to improve. That chart on the right shows the number of first-time buyer products available at different points during the year according to sort of mortgage comparison site moneyfacts.co.uk. You can see there the number of products available starting off extremely low at those higher loan to value ratios, but starting to recover through the course of the next few weeks and months, but still low in a historical context. And it's only over the next few months as we see banks becoming more confident, more comfortable with a slightly higher level of risk. And once we've got greater visibility on what the extension to the furlough scheme means and employment in those younger age categories, it's only then that we will see a real return in that ability for first-time buyers to access home ownership and for a return to those buyers to the market. So looking ahead at 2021, where do we expect things to move? Well, it's very much a year in 3 parts, although the shape of those parts, the duration of those parts of the year changes by the day as we hear of new policy changes. The first part of the year we expect to be driven by attempts to beat the end of the stamp duty holiday. Now, of course, the news this morning suggests that that has been extended. Those goalposts have been moved by another 3 months, which does suggest we could see the volatility over the year slightly dulled. The second part of the year comes as that stamp duty holiday comes to an end. Whether that is in March or in June, there will be some level of people shifting transactions forward, trying to rush transactions through before that holiday deadline comes through in order to avoid paying that stamp duty bill, making a saving of up to £15,000. Now, shifting that stamp duty holiday end date back a little bit does give you the benefit that it's no longer coming right as unemployment is expected to peak and right as the furlough scheme is about to end. But it still leaves you in a position where we would expect to see a lull in transaction activity immediately following the end of that holiday. And then as we move through to the end of the year, that's the point at which we expect to see a return to a more normal market, particularly as we've seen the vaccine rolled out to a wider proportion of the population. And as we see unemployment starting to fall, we still have a very low interest rate environment that supports a return to more normal levels of price growth across the country. Driven with tinged to some degree by a shift in the work-life balance and a shift in the expectation of how often people should return to work. And as Matt said earlier, there's no sort of firm and fast rule on exactly what that's going to look like. But as a broad conclusion, I think what we're leaning towards is to say that while it may be different for individuals, the balance is likely to be a shift towards slightly more frequent home working, if not something that's more widespread across the whole workforce. Looking at what's been going on in the rental market, there things have been a lot more polarized. It is not a new thing, however, that government has been acting to penalise buy-to-let landlords at the expense of first-time buyers to encourage home ownership. And as a result of some of those tax changes we've seen over the last few years, the introduction of a stamp duty surcharge for investors, the introduction or the reduction of mortgage interest tax relief for those mortgage landlords, we have seen buy-to-let landlords leaving the sector in their droves, with 171,000 buy-to-let mortgages having been redeemed since April 2016. But with all that reduction in supply, demand for rented homes is very much continuing. And so we see this balance where we see a reduction in the amount of rental stock and the constraints on the growth of the private rented sector, but still ample demand there. That's led to rental growth, broadly speaking, across the country, with the exception of some of the major cities over the last few months, and that's driven particularly by rental falls in central London. Over all of London, if we look in the course of 2020, we saw rents falling by about 6% over the course of the year, driven mostly, we think, by people just handing back the keys at the end of their tenancies and European workers returning to their country of origin. That does suggest, however, that as we return to a more normal level of activity, as we see those vaccines rolled out, as we see the bars and pubs and clubs and restaurants and shops reopen, we will see a resurgence in demand for those rental properties, particularly driven by those people who do not have the flexibility to work from home. If you work in a pub, working from home is not an option for you. You're probably looking for somewhere to live that is a little bit closer to work, and so having that city centre rental option is still very important prospect, a very important factor. So looking ahead, here are our rental forecasts for the next 5 years. We broadly expect to see the shape of rental growth to match income growth, but with a particular bounce in those figures expected next year in 2022 as we see a return to more urban life. That leaves us in a situation where we're expecting UK average rents to rise by 17% by the end of 2025, with London rents expected to outperform slightly, growing by 19.3%. And I believe I've accidentally zoomed rather than skipped to the next slide. Here we go. Shifting gears a little bit, looking at the development market. Clearly, COVID had a pretty significant impact on the level of housing delivery over last year. And in particular, we saw housing delivery slowed over the course of that first lockdown when there was a much greater deal of uncertainty about safe working practices and how to get workers back on site. That position has recovered somewhat since then, and over the course of the second half of the year, we saw housing delivery broadly in line with normal levels throughout most of 2020. While there is some real degree of volatility in the number of new homes being registered with energy performance certificates there in the yellow bars, and we can see that reflects towards the second half of the year, that reflects a very normal level of seasonality that we tend to see throughout the last part of December and the start of January. So that's in the positive side of that is that housing delivery is back to normal, and we've seen that ramp up back to normal levels. The negative side of that is that we have not seen the development industry making up for lost time and making up for that lost output through April and May. That recovery has been helped to some degree by the continued use of Help to Buy. Help to Buy has become increasingly important in the new homes market, supporting over 50% of new home sales in the second quarter of last year. Looking at the more recent figures, we've seen a bounce back in Help to Buy use over Q3 in those figures that we saw released earlier this week. But still, if we look at those 4-year rolling figures, they haven't yet made up again for that loss of output through the second quarter of last year. We do, of course, expect to see some changes to Help to Buy coming through. The current iteration of the Help to Buy scheme is set to end at the end of May this year, and will be replaced by a new Help to Buy scheme, which is somewhat more restricted in nature. It has been restricted to first-time buyers. That's shutting out around 20% of current Help to Buy users who are already homeowners when they use the scheme. We're also seeing regional price caps introduced, bringing that price cap for the scheme down from £600,000 everywhere, as it was previously, with lower regional price caps introduced, as low as £180,000 in the northeast of England. Now, that's likely to have an impact on the types and locations of homes that developers are looking to build, and the routes to market they are willing to take. It's likely to shift development to lower value locations. It is likely to shift housing delivery towards smaller properties that are more affordable, and it could lead to house builders looking to enter partnerships with housing associations or with private investors to de-risk, to reduce their exposure to sales risk, and to sell some of those units before they start constructing them. However, if we look at the biggest obstacles to housing delivery at the moment, or as of last year, the vast majority of the respondents to that survey are reporting planning delays as being their key concern. Despite a shift to planning committees over Zoom, we have seen planning delays increase over the course of the pandemic, and that has produced greater obstacles to bringing homes through for delivery. Despite some of the earlier sort of headlines about queues at Dover and lorries being stuck at channel crossings, materials availability has risen up slightly up the rankings there as an obstacle to housing delivery, but remains below the availability of land as an obstacle to delivering more homes. So to sum up, I think I'm just going to I'm going to sort of run through the greatest uncertainty of all. And unfortunately, it's not a pandemic, it's not a global recession. The greatest uncertainty that any of us have to face at this stage is what on earth government is going to do next. You can see from the first item there that I produced these slides before this morning and therefore hadn't yet accounted for the headline saying that a stamp duty holiday is likely to come through. But of course, we do have the additional prospects there of trying to work out exactly what a 3-month extension to the stamp duty holiday means. In short, it's likely to mean that we see a less volatile year for transactions, but it also raises questions about whether we see further stamp duty reform once that holiday comes to an end in June rather than in March. We've also got further government pressure to implement net zero carbon, which will increase build costs and could affect residential investment. Potential reform to capital gains tax, which I will leave to the tax experts to discuss in more detail. The renters reform bill, making it harder for landlords to gain vacant possession of their properties. And of course, further up on the horizon, the prospect of the infrastructure levy and first homes affecting the viability of new housing delivery. I'm going to leave those as questions rather than trying to go into each of those in detail now. But I believe on the theme of questions, we've already got quite a few questions through on the Q&A. So I'd just like to say thank you very much, and I will pass back to Howard to chair this questioning session. Thank you.
Thank you very much, Matt and Lawrence. We had I'm pleased to have a number of questions from the audience, so I hope you enjoyed those sessions. There's been quite a lot of interaction, so I'm pleased to say. So first question is for Matt. And the question is the apparent increase in investment volume skewed by fewer larger deals, or is it a lot of smaller lot sizes?
It's not skewed at all, actually. I would say probably a reasonably normal sample. You know, there's probably slightly less portfolio activity over the last few months, and slightly less big London office deals. So no, nothing. The only sort of notable aberration in the commercial property market data is that an increasing amount of the stuff that I count as commercial isn't actually commercial. It's multifamily, it's seniors housing, it's those kind of things. So I may have to hand those numbers over to Lawrence someday.
Okay. Next question, this may well be for both of you actually. The question is, many office or retail sites are not suitable for conversion to resi. Do you have any data on the percentages where that is the case, or would you have a view on generally what's going to happen to expand the question on surplus retail and office?
Yeah, I'm not sure that I would say many. I would say the only bits of, we reckon that somewhere around 20% of UK retail is surplus to requirements or will become so. The only bits of that are not suitable for conversion to resi are probably the department stores, which tend to be big, deep floor plates, the very, very big shops. Everything else, I think, is whether it's shops on high streets through to retail warehouse parks is suitable for conversion. And it's not just about conversion to resi. The Debenhams in Oxford, for example, was recently subject to fairly hot bidding, and we understand it may well go to be laboratory space. We're also seeing, lab operators interested in retail warehouse schemes. Obviously, there's conversion to logistics and last mile a factor. So I think quite a lot will go to resi. I just think the big problem is the sort of high street stuff. The ownership is so granular. Actually, even if the shop is vacant, is it worth the landlord converting it to resi, the ground floor?
Thank you.
I think further to that, we've got a greater appreciation, certainly from local authorities and definitely from national government now, that many of, while there are some excellent, exceptional, and I use exceptional in its literal sense, examples of very good office to residential conversions, there's an awful lot of bad kit out there. And there's greater, we can expect to see greater pressure from government there to ensure that if you are going to convert offices or retail space into residential, there will be restrictions on minimum unit sizes. There will be restrictions on, the ability to provide those homes without also providing some form of affordable housing contribution. So I think, we don't expect, I would not expect to see a sort of completely unrestricted market in the way that perhaps we have done in some markets. Bristol springs to mind as a particular hotspot. I think we're likely to see a little bit more regulation on those residential conversions looking ahead.
Okay, thank you. Lawrence, this is definitely one for you, and the question is, has the London resi bubble burst in favour of the Shires?
So we get this one a lot, and I think certainly the initial response in the early days of the pandemic was we had a huge increase in the number of calls to our country house agents and to our agents in sort of residential agency offices in rural locations, in village locations. I suspect that's all going to reverse as soon as the pubs are back open. At the moment, the demand for city life has been dulled somewhat, because if you are lucky enough to live in London or another major city, a lot of the factors that would be drawing you to live there, the convenience, being very close to work, having all of these cultural offerings, the restaurants, the museums, the theatres and so on your doorstep, none of it's open. Whereas in 6 months' time, when we do see these facilities and amenities back open again, then we can expect to see that demand return. And of course, that's not just for the people visiting them and enjoying them. If you are working in these locations, you want to be living somewhere nearby, and so that demand is still going to be very much there once we return to a more normal economy with those city centre amenities back up and running again.
Thank you. And now one from north of the border, from someone in Edinburgh, who's asked that who has said that the market has been heavily impacted by the Airbnb market joining PRS, which has created an oversupply in the city. Do you have a view on the short-term rental market, either in Edinburgh or generally?
I mean, we saw, I think the quickest measure of Airbnb supply being flipped over to longer term lets was just looking on Rightmove and seeing the number of photographs of properties where they had towels folded up on the beds. And yes, there was a particular concentration of those in Edinburgh, I think particularly as people realised that the fringe wouldn't be going ahead. I think that's, clearly that's caused issues with oversupply in some parts of the PRS. Edinburgh stands out, but so do certain parts of central London, where there was a real reliance on that short-term let business. Again, as we see a return to these, the international travel, as we see a return to leisure travel, we can expect to see landlords taking a view on those properties and saying, actually, I like the flexibility, I like the higher returns that I can get from a short-term let versus the additional regulation I'm going to face, working on assured short-hold tenancies, where increasingly government is rewriting the rules there to give more and more power to tenants. Thank you.
And I think this is probably one for both of you, although there is a focus on resi. To what extent do the panel think that BTR will increase over the medium term?
I think there's two parts to that. I think in terms of one of the bits of analysis that we've done recently was to look at the scale of the UK build-to-rent market as it stands at the moment, and comparing that to more mature residential, sort of institutionally invested residential markets in different parts of the world. And we found there that if you compare to the USA, for instance, there around 50% of privately rented homes are owned by some kind of institution or investment trust or large-scale investor. So it's not unreasonable to think that in the long term you could reach that level of sort of market ownership, of institutional ownership in the UK's residential, sort of rented residential sector, and that would suggest ultimately getting to a point where you've got around 2.5 million homes owned by those institutional investors. I think in terms of whether that stock is purpose built for the rental market, however, there you've got a much smaller rate of investment and a much smaller rate of growth, just simply because we're not building homes fast enough. We've currently got around 54,000 completed build-to-rent homes, most of which are arguably built for the market, but many of which have just been converted from general use. They were going to be sold on the open market, and now they've been flipped to an institutional landlord. So that market will continue to grow very rapidly and will increase. We can expect to see that double or treble over the next 5 years. But you're still talking about 100,000 homes out of 4.5–5 million privately rented households across the UK.
Good. Matt, do you have any view on that? Or
there is no shortage of investor demand for this. The problem, as Lawrence quite rightly says, is supply, and people prepared to build this stuff. But I depends on one's definition of medium term. But I see no reason why this shouldn't become the dominant institutional real estate asset class over the long term in the UK. It's absolutely logical. It has all the characteristics that people buy property for, which is long-term secure income streams, and it's just a question of, can we find a way of delivering it, building it quick enough? Because every single one of my traditional commercial property investing clients would like to buy this sector.
It's worth noting as well. It's not, when we talk about residential as an asset class here, build to rent is part of that. It's a very obvious part of that that's made the headlines for a lot recently, but it is far from the only one. And the increase in investment we've seen in affordable housing, for instance, with Blackstone, Legal & General, M&G all piling into the sector there, the increase in investment we've seen in student accommodation, in senior housing, there are many strings to the residential bow. And I think those investors are increasingly looking at the opportunities to integrate across those different aspects of residential. So it's not just build to rent we're expecting to see grow, it's all across those different residential sort of things with beds in class.
Thank you. I'm conscious we're fast approaching 10 o'clock, and I'm sorry I haven't been asked to ask a number of the questions that some of the participants have sent in to me. So what I'd like to do is really to thank Matt and Lawrence for their time this morning, and as always, it's been a very interesting presentation from you both, so thank you again. If you would like some more information, there's some details that I'll just put up on the screen. If you want to download our Real Estate 360 report. We've also recorded this session, so I'm sure that will be available to you all in due course if you want to run through and do a rerun of any part of what Matt, Lawrence and I have said. So finally, can I thank you all for attending? I hope you've enjoyed this session, and hopefully we'll look forward to seeing you again, if not virtually, physically, in a not far too distant future. So thank you.